Hey folks, how you doing? It is Friday, May 9th, 2025. And what's going on in the Bitcoin and crypto markets? If you saw my video earlier today, you saw that I mentioned the various mean reversions on the various different time frames. We've now clocked a new 4-hour candle on Bitcoin, and now Bitcoin on the 4-hour is also in mean reversion to the 3012 RMLR below, which means, again, which translates, if you will, into it gives you great targets, right? The moving targets of the RMLR and the third band to the upside of the 3012 RMLR. What does that mean? What does that in practical terms translate into? Well, it translates into you have a moving target, which is the RMLR for the mean reversion, and you have a moving target, which is the third band to the upside of the same RMLR, the third standard deviation band. So if it continues to run up, it is more than likely not going to hit that third band before it pulls back to the RMLR. It could run up real close to it multiple times. It is not likely to touch it. It may touch it. There's a very, very, very small probability. So if it gets close to it, front run, you take profit. Don't sit there and wait for it to hit it, because it probably won't. And again, even if it does, it'll probably snap through back and forth. It'll run through it and snap back very quickly. If it pulls an extreme outlier, where like less than 0.001%, where it runs through that third standard deviation band and stays above it, shifting all the probabilities to obviously new calculations. It certainly is possible. It's extremely unlikely, but it certainly can. But that increases the probability that once it pulls back through that third standard deviation band, it will complete that mean reversion after that. Like an extremely, more than 99.9% probability at that point that it will in fact complete that mean reversion before touching that band again. So for now, it's like a 99.7% probability already that it'll complete the mean reversion before hitting that band again. Okay, now does it mean it can't run up? No, it certainly can run up. There's plenty of room to run to the upside before it hits that band again, and it certainly can do that on the 4-hour time frame, and it can do that for a good long while, right? For many candles in a row. That could be days, could even be weeks, frankly. You got to keep in mind on like the higher time frames, like the weekly, which I spoke about at the beginning of the week. We saw that this week was still well within the range for a significant move relative to the time frame, and we certainly have seen a nice significant move to the upside this week so far. That doesn't mean it has to finish the week necessarily to the upside, but it certainly looks like it probably will for now. And we are again well within the range of even having another decent move even next week. So we'll see. But after a week like this, we'll see how it plays out. For now, we still have today, tomorrow, and Sunday to finish up before the end of this weekly candle. But on the lower time frames, like the daily and the 4-hour, on the 4-hour, there's mean reversions. Like I said, in play, there's a mean reversion on the 3012 RMLR, and of course, on lower time frames, there are other mean reversions consistently happening. And on some other assets like Solana, also on the 4-hour, there is a mean reversion at play to the 3012 RMLR, and plenty of other assets across the crypto market as well. There are 4-hour mean reversions. Some of them are on daily. For example, Bonk has mean reversion happening. It's a meme coin on the Solana chain. Has a mean reversion happening also on the 4-hour, and also has a mean reversion happening on the daily, which it certainly could happen. Maybe in the coming days, we'll see. Maybe by Monday, maybe sooner, maybe a little bit later in the week. We'll see. That's why we look at low time frames when we trade intraday, obviously, because we're not trading super high time frames when we're trading intraday, right? Yes, super high time frames are interesting to understand the big picture, but we don't use that information for the overall trading decision in the moment on the day, right? We just have to keep in the back of our mind, yes, the propensity is to the upside, the downside, or sideways on the super high time frames, but it's the lower time frames that are actually, of relevance, 15-minute and under, for example. If you're trading lower time frames like 6-minute, 3-minute, 1 minute, or lower, right? So yeah, keep that in mind. Now, bigger picture, aside from trading, outside of trading, again, what is happening with crypto, right? What's the general direction? What is this quote-unquote bull run going to deliver, if anything? Right? Well, if there is a sustained period of buy pressure, which is what people typically call a bull run, even though I've told you many times there's no such thing as a bull run or a bear market. There's just sustained buy pressure, sustained sell pressure, right? But whatever, let's say this is the same thing. This period of buy pressure, people want to know, is it going to end this year, or are we already there? Is it time to sell in May and go away? Have we hit the highs of the year at 108 back in January? Should we already get out of this thing before it dumps back down to the high 80s or low 90s on Bitcoin? Or is it going to dump even further? Is it a good time to get out? Look, if you're trading intraday, it doesn't matter what the price is. It's completely irrelevant. It's completely moot if you're trading intraday. If you are trading long-term positions, right, if you're really an investor, whether it's a short-term investment like weeks or months, or a longer-term investment of years or decades, these things all make a difference, right? So if you're a long-term investor of years or decades, it's kind of a no-brainer that you should just keep stacking DCA, no leverage, obviously. Just stack and rack and keep adding to your stack every regular period, like your DCA plan says, right? So if you're buying weekly, keep buying weekly. If you're buying monthly, keep buying monthly. If you're buying every 3 months, keep buying every 3 months. And how much you should buy is entirely up to you. And you should keep that amount consistent. Because if you don't keep it consistent, you are not dollar cost averaging. Now, are there exceptions to the rule when the market has a massive dip and it's a huge buying opportunity? There may be, yes, there are, right? But does that mean you should necessarily break your DCA pattern? Let's say you allocate whatever it is, $1,000 a week or $1,000 a month. Should you all of a sudden buy 2,000 or 3,000 after a huge dip? You really have to know how to read the VEPs to make that decision. You have to know how to read the information to make that decision. Because if you don't, you could be putting in a significant amount, and then it could dip even harder, right? And then, well, you missed your huge buying opportunity at even lower prices. But, generally speaking, that's why DCA is DCA, and you don't change the number that you stack, right? And any amount that you do veer from, understand that is a gamble, right? Much more than the DCA. The DCA is like the least gambling way to invest because of the nature of markets to drift up in value over the long term, because they're based on the fiat monetary system, or the currency system that currently is based on infinite money, right? They just keep printing and printing. So the more they print, the less purchasing power each fiat currency unit has, right? So whether it's dollars or euros or pounds or yen or shekels or yuan or whatever you're using as your fiat currency, right? The more they print it, the less purchasing power it has. So that means over time, things will cost more, right? Why is your bread, loaf costing you $4 now instead of $2 7 years ago? Because there's less purchasing power for your dollar now than there was 7 years ago, right? About twice as much, right? So you lost about 50% of your purchasing power in the last 7 years. And it's roughly every 7 years, by the way. Sometimes 5, sometimes 8, whatever. It's on average, every 7 years, you lose about 50% of your purchasing power, which is why prices keep doubling, if you notice, roughly every 7 years. And yes, sometimes they double faster, sometimes they double slower, like when we had the whole thing in 2020 where the world, had to go home and stay home for a while, and all the businesses had to, all the small businesses had to shut down temporarily. That obviously increased prices dramatically following that, except for, obviously oil and gas had an immediate sharp drop, but they quickly recovered because nobody was driving, right? But that quickly went back up to normal, kind of, relatively normal prices because, well, people started driving again after some weeks or months, depending on where you were, like driving in normal, amounts. So it's, it is unusual to have, of course, historical outliers in terms of massive dumps. And that's why when you do have them, like we had a few weeks ago, when the whole market went crazy saying, oh, the tariffs killed the markets. No, the tariffs did not kill the markets. The tariffs were a narrative used to explain why the markets went down, when in fact the markets were just literally mean reverting, and we could see it time and time again. If you look at the S&P as a standard kind of default measurement of the U.S. market, the S&P was well due for a mean reversion, and it was already happening, right, since January, because we'd reached all-time highs, and the returns were looking very much set for a mean reversion to the mean of returns, and indeed that's exactly what happened. And they dipped very nicely, and they dipped very solidly. And of course, people will say, well, they dropped harder because of the news of the tariffs. No, they dropped harder because there was more sell pressure. Why was there more sell pressure? Because the algorithms that run the markets decided this is a good place to short based on the maths. Okay? And traders who represent maybe 20%, like individual retail traders who represent maybe 20% of the market, saw that and decided for themselves, yeah, it's time to dump, But does that mean that there was necessarily a significant, market crash? No, there wasn't. There was just mean reversion. Look at S&P on the weekly and on the monthly. It has not had a huge, significant, crash of historic proportion. Yeah, it had a big, nice pullback. Okay, that pullback was a mean reversion. And again, I'm not. I say this to you as someone who's not a fan of the current administration in many ways. Okay, I don't hate the administration, but I don't love the administration. That is for sure. I have probably not probably. I have more criticisms of them than I have nice things to say. Do I have some good things to say? Yeah, I think there's some policies they're doing that are good, sort of. But as I said from the outset, I believe even those policies are purely transactional, and we've already seen it play out. I don't want to get in that discussion right now, but there's very strong evidence to demonstrate that the relationship that I'm thinking of and the policy that I'm thinking of is purely transactional, and it's already been shown to be that way based on U.S. actions, in recent days. So again, the market was not collapsing because of the tariffs. That's just utter nonsense. Okay, it's media hype to get people excited one way or the other, and the market was not, amazing because of the tariffs. No, the markets moved because of the VEPs. That's why the markets move. They're bots that run the markets. They're huge algorithms run by HFT firms. Economic policy, monetary policy, however big the news may appear to be, does not move the markets intraday. Okay, it simply does not. What does move the markets intraday is the VEPs. Now, I know people will put narrative on that, and they will say, no, it's because of this story. Well, you can believe that all you want, but the math speaks for itself. If the markets had gone the other way, right, if they bounced first even higher before pulling back, then people would have said, oh, look how great they are. And then when they came crashing down, people who said, look how terrible they are, would be saying it louder. Now it's the other way. It dumped first, and people said, look how terrible they are. And then all of a sudden, the markets bounced back up significantly. I think they're almost at where they were pre-dump, right? And even if not all the way, they've come back a long way, and they've already done quite nicely. And certainly in crypto, we've seen the markets going up significantly since people were freaking out a few weeks ago. And they're way up above compared to where they were a few weeks ago in most cases. So that's just more evidence that it was not anything to do with those policies, because if it were, they'd still be down in the dumps, because those policies are still in effect, even though they're technically on pause for 90 days, right? Those 90 days are running out really quickly. So, yeah, keep that in mind. Are we going to see generally big picture higher numbers by the end of the year, between now and the end of the year sometime? Are we going to see Bitcoin break the new all-time highs? There's a pretty decent probability that we'll see Bitcoin break the new all-time high. But again, it doesn't matter, right? If you're intraday trading, right? It really doesn't matter. Long term, like 5-10 years from now, I have practically no doubt that we'll see much higher numbers. But yeah, that's it for now. I'll talk to you guys later. Happy trading. Peace.